Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So, imagine discovering that the prime commercial property backing a multi-million-pound corporate loan on your books has, well, simultaneously been pledged to three other banks.
Yeah, which is terrifying.
Right. That hidden opaque risk just cost HSBC $400 million in a single shadow banking collapse.
Wow.
And add to that, Santander wiping the 215-year-old TSB brand off the high street to survive a brutal cost-cutting environment.
Oh, absolutely.
Plus, government borrowing costs are hitting a 28-year high amid massive political fragmentation. So, you really start to see a pattern here. Why should you care? Because political instability might put bank taxes right back in the crosshairs.
We are undoubtedly entering an era defined by, well, I call it the hidden cost of complexity.
I like that.
Yeah, because whether we're looking at opaque private credit chains suddenly unraveling or, the brutal operational reality of integrating a £2.6 billion retail banking acquisition.
Which is massive.
Exactly. Or even a fragile national budget reacting violently to geopolitical shocks.
Yeah.
The underlying theme is always the same. The risks are no longer simple, and they certainly aren't transparent.
Yeah, and for those of you listening who work in retail banking strategy or commercial growth or risk management, this deep dive into our recent sources proves one terrifying point.
Go on.
The biggest threats to your institution's survival aren't sitting neatly in your Tier 1 capital ratios. They are hiding in third-party securitizations, unpredictable election ballots, and a regulatory perimeter that is shifting right beneath our feet.
Yeah, spot on. And I think the best place to start untangling this is the macro picture, really. Because the bond markets are practically sounding an alarm bell right now.
They really are.
According to reporting from the BBC and the Telegraph, the UK 30-year gilt yield has hit a 28-year high of 5.78%.
That is, that's huge.
It is. And the 10-year yield isn't far behind, hitting 5.1%.
And that spike is being driven globally by the Iran war and the effective closure of the Strait of Hormuz.
Right.
Because when global shipping routes close, energy prices skyrocket, inflation fears return, and, investors just demand higher yields.
Naturally.
But we also have a very specific domestic story compounding this. The recent local elections were widely described across our sources as a bloodbath for the Labour Party.
Yeah, the results were quite traumatic.
With Reform UK making massive disruptive gains and seizing control in places like Wigan, Tameside, and Havering. And just a quick note for you listening, we are impartially reporting the market reactions to these election results and the viewpoints of the sources provided.
Absolutely.
We aren't taking any political sides here. We are simply following the money.
And the money is incredibly nervous about political fragmentation, isn't it?
Oh, completely.
You have to understand how yields function as a real-time gauge of economic anxiety. When international investors lose confidence in a government's ability to maintain stability, they sell off government bonds.
Right. They just dump them.
Yeah, and the price of the bond falls, which means the yield, the effective cost of borrowing for the state, just shoots up.
Makes sense.
A weakened government facing unpredictable opposition severely restricts the chancellor's fiscal budget. And, as the Telegraph pointed out, the Treasury is already battling the monstrous legacy of quantitative easing.
Ah, the QE trap. That is fascinating when you actually break down the mechanics of it.
It really is.
Essentially, to stimulate the economy over the last decade, the Bank of England created electronic reserves to buy up government gilts.
Yes.
So the government essentially took out a massive variable rate loan to fund a fixed rate spending habit.
That's a great way to put it.
And now that interest rates have had to rise to fight inflation, the Treasury is suddenly forced to pay significantly more to service those central bank reserves held by commercial banks.
Right.
Which is way more than it ever paid on the original long-term gilt coupons.
That variable rate mortgage analogy is spot on. High yields are entirely wiping out the government's fiscal wiggle room.
Completely.
And the UK has lost its captive buyer. Historically, UK-defined benefit pension funds were forced by regulation to hold massive amounts of gilts.
Oh, right, because of the strict rules around those guaranteed payouts.
Exactly. But as the workforce shifted away from those golden ticket pensions towards defined contribution schemes, which heavily favor equities that guarantee domestic demand, just dried up.
So who is buying them now?
Well, The UK is now entirely reliant on flighty international hedge fund investors who demand a higher risk premium the moment political instability flashes on their screens.
Which brings this directly to the door of the banking sector.
Always does.
Because to fund public spending without breaking their own fiscal rules, there are very real fears that a leadership change could see the bank corporation tax surcharge hiked from 3% to 5%.
Yeah, that's the real threat here.
Yeah. Mayor Andy Burnham recently said that policy is too much in hock to bond markets. But the reality is the banking sector often ends up being the default piggy bank when the Treasury needs to appease those bond markets.
Well, the UK tax burden is already on course to reach its highest level since the Second World War.
Wow.
Banks operating in the UK already face a total tax rate of over 46% when you factor in the existing surcharge, the bank levy, and standard corporation tax.
46%.
Yeah. Compare that to 27.9% in the United States.
Yeah.
If a new administration pushes the surcharge to 5%, you hit the very edge of the Laffer curve.
Okay, let's unpack this for a second. The Laffer curve. That's the economic principle where you push tax rates so high that you actually stifle business activity, right?
Oh, exactly.
And ultimately, you end up collecting less total tax revenue because the underlying economy just shrinks. But are we overreacting to local election jitters? Or is the real structural issue that the UK banking sector is just an easy ATM for the Treasury whenever bond markets throw a tantrum?
I think it's the latter. For a retail bank, an increased tax burden directly stifles lending capacity and reduces returns on retail deposits.
Yeah.
It becomes a balance sheet risk that gets passed straight onto the consumer in the form of worse rates and tighter credit.
So if you are sitting in a strategy or commercial role this week, you need to proactively stress test your capital allocation models against a potential 5% bank corporation tax surcharge.
Don't wait for a manifesto announcement.
Exactly. And if you are in risk, monitor your sovereign debt exposure and aggressively review how a sustained 5% plus yield environment impacts your mortgage pricing models.
Because affordability for the average UK borrower is already stretched to the absolute limit.
It really is. And that macro squeeze on borrowers leads us perfectly into the shadow banking sector.
Ah, yes, the hidden plumbing.
Right. The Financial Stability Board has just issued a stark warning about the private credit market.
Which is huge now.
Yeah, massive. They estimate this largely opaque market has ballooned to between $1.5 and $2 trillion globally, and it is heavily concentrated in tech, AI data centers, and healthcare.
And we are already seeing the casualties from this bubble bursting into the mainstream, aren't we?
We are. HSBC has taken a $400 million hit.
Good grief.
And Barclays reported a £228 million impairment. Both of these massive losses are directly linked to Market Financial Solutions, or MFS.
Right.
This was a UK bridging lender that collapsed amid allegations of double pledging property collateral.
It's just unbelievable.
To understand the mechanics of this fraud, imagine taking a single commercial property, getting it officially valued, and then using that exact same...
The anatomy of the MFS scandal is absolutely critical for any regulated institution to understand. MFS was what the Financial Conduct Authority categorizes as an Annex 1 firm.
Meaning they were only supervised for anti-money laundering purposes.
Precisely. They had zero prudential regulation.
No capital buffer requirements, no strict liquidity ratios, nothing.
Yet, despite being essentially unregulated for risk, they managed to access billions in funding from systemically important global banks through secondary securitizations and financial sponsors.
It's wild.
When this lightly regulated shadow bank collapsed, the losses rippled straight up the complex financial chain and landed squarely on the regulated bank's balance sheets.
Which is exactly what the FSB is worried about.
Right. The FSB report explicitly warns about the growing use of payment in kind, or PIK loans, within this sector.
Oh, payment in kind loans are terrifying in a high-interest environment.
They really are.
For those who might not deal with them daily, it's the equivalent of a consumer paying their monthly credit card bill by simply rolling the interest charge into the principal balance.
Exactly. No cash actually changes hands.
The debt just grows. It artificially masks default risk until the borrower hits their hard credit limit, at which point the entire structure implodes.
And private credit borrowers typically lack public ratings and have significantly lower credit quality to begin with.
Right.
So these highly leveraged shadow market borrowers start defaulting because of the high-yield macro environment we just discussed. This intricate web of bank exposures to private credit is going to unravel incredibly fast.
Here's where it gets really interesting, though. Banks love to claim these exposures are idiosyncratic, a one-off fraud.
They always say that.
But if a globally systemic bank can lose nearly $500 million to a London bridging lender that most people have never even heard of, it raises a massive red flag.
Absolutely.
Are major retail banks using these complex securitizations to chase high yields while intentionally keeping themselves blind to the underlying borrower risk? I mean, are we staring at the UK's Wirecard moment?
I think we might be. The complexity is entirely the point. It obscures the true risk profile.
Right.
You don't see the bad loans because they are bundled up in a sponsor-backed securitization.
Out of sight, out of mind.
Exactly. So for the strategy and commercial teams listening, your priority next week must be reviewing your firm's appetite for sponsor-backed securitizations and asset-based finance, particularly in the tech and AI sectors where the FSB has flagged extreme concentration risk.
And for the risk teams, you cannot afford to assume a financial sponsor has done the due diligence for you. You need to conduct a deep dive audit of all indirect credit exposures to Annex 1 lenders and non-bank financial intermediaries immediately.
Definitely.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So moving on, this severe pressure on balance sheets from potential tax hikes and shadow banking write-downs is directly forcing retail banks into defensive postures.
Very defensive.
As reported by the Financial Times, Santander has finalized its £2.6 billion takeover of TSB.
This is going to be a brutal integration.
Oh, without a doubt.
Santander is planning to completely erase the 215-year-old TSB brand from the UK high street within 12 months.
Which is historically significant.
It is. They are aiming to achieve over £400 million in cost savings, which means shedding roughly 55% of TSB's entire legacy cost base.
Consolidation of this magnitude inevitably means fewer choices for consumers and aggressive cost-cutting, which translates to widespread branch closures and highly complex IT migrations.
Yeah.
You simply cannot rip £400 million out of an operating model without taking on massive operational and conduct risks.
And you only have to look at the recent internal uproar at KPMG for a masterclass in operational risk mismanagement during a restructuring.
Well, that was a disaster.
According to City AM, KPMG laid off 440 junior managers. But due to a severe communication system breakdown, staff were receiving automated emails praising the firm's robust business performance just moments before their redundancy calendar invites arrived.
I read about that. It's just awful.
The internal cultural damage was catastrophic. If Santander mismanages this aggressive TSB integration, they won't just face an IT outage. They will face a full-blown culture and operational resilience crisis.
And that operational risk sits right alongside massive legacy conduct issues.
Oh, the motor finance.
Yes. Santander recently had to provision £633 million for historic motor finance mis-selling.
$633 million.
And this massive redress bill is playing out at the exact same moment that the FCA and the Solicitors Regulation Authority are launching a massive coordinated review into claims management companies, or CMCs.
This is what I call a bizarre pincer movement by the regulators.
I mean,
Well, on one side, the FCA is forcing retail banks to pay out hundreds of millions for past misconduct in motor finance.
right.
But on the other side, they are actively having to police the very claims management firms that are aggressively trying to profit from that exact same misconduct.
Oh, I see.
It's like a referee trying to penalize a player on the pitch while simultaneously holding back a mob of fans trying to rush the field to steal the player's boots.
That is a very vivid analogy, but it's true.
The FCA has already removed 800 misleading CMC adverts and had to help 28,000 consumers exit unfair contracts where these intermediary firms were skimming massive, unreasonable exit fees off the top of the compensation.
We also saw the recent liquidation of an FCA-authorized credit broker, Canda Products and Services, due to severe appointed representative control weaknesses.
Yeah, let's clarify that mechanism for a moment for those who might not touch it daily.
Sure.
An appointed representative structure is where a fully regulated principal firm essentially rents out its regulatory permissions to a smaller, unregulated firm.
Exactly.
But when that smaller firm goes rogue or fails, the principal firm is entirely on the hook. It's another example of the FCA aggressively policing the perimeter of the market where complexity hides risk. But I have to ask.
Yeah.
Is the FCA's crackdown on claims management companies actually about protecting consumers from aggressive marketing? Or is it secretly a way to shield the major retail banks from a catastrophic, unmanageable wave of redress claims?
Look, the regulators desperately need this massive redress process to be orderly.
True.
The FCA has a mandate to protect consumers, sure, but it also has a statutory objective regarding the integrity of the broader financial system.
Right, they can't let the banks just collapse.
Exactly. If CMCs create a bottleneck of meritless automated claims, the consumer loses out on their compensation. But simultaneously, if a flood of low-quality claims overwhelms the operational capacity of the major retail banks, the entire system grinds to a halt and destabilizes capital.
Orderly execution is everything.
It is.
So if you are in strategy or commercial, there is a tangible opportunity amidst this chaos. You need to prepare targeted acquisition campaigns to capture legacy TSB customers who are going to feel, well, disenchanted by their historic brand disappearing and their local branches shutting down.
It's a huge moment for customer acquisition.
Absolutely. And for risk teams, you need to rigorously reevaluate your operational resilience framework.
Especially with the new rules coming.
Exactly. With the new payment safeguarding rules coming to force in May 2026, you need to ensure your internal and external communications ahead of any IT migrations or restructuring are bulletproof.
Yeah, do not allow a KPMG-style communication failure to destroy your internal culture.
So moving on to our final big story, we need to look at how regulators are approaching the infrastructure of the future.
The payment space.
Yeah. The FCA has confirmed it has opened a formal investigation under the Competition Act 1998 into MasterCard, Visa, and PayPal.
This is a highly unusual and aggressive move for the FCA to use these specific antitrust powers.
It really is. They are investigating suspected anti-competitive conduct related to the funding and usage of PayPal's digital wallet.
Yeah.
They are deploying Chapter 1 rules, which specifically target anti-competitive agreements and backroom cartels between companies. And they're using that alongside Chapter 2 rules, which target the abuse of a dominant market position by giants like MasterCard and Visa.
And the reason this matters fundamentally for UK retail banks comes down to the sheer velocity of consumer behavior change.
It's moving so fast.
According to the FCA and the payment systems regulator, digital wallet usage for card transactions has skyrocketed from just 8% of transactions in 2023 to an astonishing 29% in late 2024.
That is incredible growth.
It is. And for a retail bank, losing the front door of the customer interaction to a tech giant is an existential threat.
Absolutely.
The outcome of this antitrust investigation could permanently alter the economics of interchange fees, dictate the rules around wallet usage, and shift the balance of power away from traditional banks.
And regulators across the board are waking up to this. It perfectly parallels the Competition and Markets Authority's ongoing inquiry into Apple and Google's mobile ecosystems.
They are desperately trying to inject competition into our digital infrastructure before these monopolies become entirely entrenched.
But I have to ask, this feels a bit like the authorities trying to issue a speeding ticket at the Indy 500.
How so?
Well, by the time the FCA finishes gathering evidence, holding hearings, and issuing a final legal decision on PayPal, won't Apple and Google have already completely and utterly cornered the UK digital wallet market anyway?
Well, regulatory lag is a massive concern, obviously, but setting a firm legal precedent under the Competition Act is vital for the long-term health of the sector.
Even if it takes years.
Even if it takes years.
Right.
Breaking these anti-competitive contractual provisions is the only way to ensure that open banking initiatives and future payment innovations can actually gain a foothold.
I suppose that makes sense.
Because
Right.
if the underlying infrastructure remains locked down by restrictive covenants between the card schemes and the tech giants, it doesn't matter how fast the market moves. The incumbents will always win, and retail banks will be permanently relegated to dumb pipes.
Right. Which means inaction is not an option.
Exactly.
So action items for next week on this front. Strategy and commercial teams, you need to pull the commercial terms of your institution's digital wallet partnerships right now.
Don't wait.
Assess your vulnerabilities to any sudden regulator-enforced changes in routing rules or fee structures. And risk teams, ensure your legal departments are actively reviewing any exclusive payment agreements your bank holds for strict competition compliance, especially now that the FCA is flexing its antitrust muscles.
Right. Time for a rapid-fire recap.
Go for it.
This week has been entirely about the hidden costs of complexity. Watch out for bond market volatility, increasing your political and tax risks. Check your blind spots regarding Annex 1 shadow banks and private credit leverage, because those shadow losses will inevitably flow back to your regulated balance sheet.
Yep.
Prepare for high street consolidation to bring operational resilience and culture front and center. And watch the digital wallet space incredibly closely as the FCA brings out the antitrust hammer.
Brilliant summary. We've spent this deep dive talking about rules, regulations, and market reactions, but consider this provocative thought as you head into the office on Monday.
Let's hear it.
What if the biggest risk to your bank's balance sheet isn't the upcoming regulation you are aggressively preparing for, but the unregulated complex edges of the market where you simply assume someone else has done the due diligence?
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp, stay informed, and stay compliant.